Hi, welcome back to a new video on the Great Depression. Today we're going to talk about the causes of the Great Depression, and specifically we're going to talk about the stock market crash and what contributed to the downfall of the Roaring Twenties stock market. It's important to note right at the top that the stock market crash is not the cause of the Great Depression. It is more of a symptom of the economic dominoes that were the 1920s that led to the general crash, and than it is an actual cause. It's very much like Franz Ferdinand's assassination is to World War One. Without this, I mean, we wouldn't maybe have had a genuine depression when we did, but it's probably more an indication of where the cards were than it is an actual cause of the depression. Nonetheless, we're going to talk about the stock market crash and how the economic system led to this. So let's get going. First off, it is important to know some political background here of the 1920s, specifically the election of 1928, because the president at the time, Herbert Hoover, and his philosophy is going to change the general response to depression, which will ultimately lead us to the New Deal. Okay, so first off, Hoover's philosophy. Hoover was the Treasury Secretary, Commerce Secretary in the 1920s. He was the leader of the highly successful Food Administration in World War I. He is a lifelong administrator and politician. In the Roaring Twenties, the policies were often business-centered and led to consumerism and a booming economy in the urban areas of the 20s. The rural areas, not so much. But Hoover specifically advocated for continuation of Calvin Coolidge's policies. Keep cool with Coolidge, kind of hands off. We don't want to get too controversial when it comes to our government policies in the economy. Plus, he was a big proponent of what we call rugged individualism, which is an emphasis on personal liberty and limited government involvement in the economy. In general, he was afraid that too much government involvement would only create a more problematic economy for America, which led him, in the eyes of the public, to do nothing, which is not true, but it's going to cause his political downfall after the Depression. Had everything continued to be wonderful for urban areas, then maybe Hoover's legacy would be something a little different. So we can obviously predict how Hoover's going to respond to the Depression, and it's not going to be that popular. Now, on to the stock market crash. It's important to understand that the 20s stock market was a bull market, or a period of sustained growth in the stock market, noted by increased buying. The government policies, along with the general attitudes towards money and the self-fulfilling prophecy of the market will only always go up, led to the bull market. We've had some impressive bull runs in the United States in our history. The most recent one from 2009 to 2020 having just ended. But basically, if the stocks keep going up, people keep making money, and that encourages them to buy more and more and more. It's kind of a psychological impact then, where everyone else is getting rich, so more people buy in, and more people buy in, and more people buy in. Recently, with the GameStop surge in value, and I don't know how long that reference is going to last. I'm recording this in 2022, so hopefully maybe you understand what I'm talking about. But the psychological fear of missing out leads to even more buying. So this kind of sustains itself, and the stocks could essentially go up forever. But at some point, someone's going to cash out, and you're going to run out of buyers for the stocks. And this is where we need to talk about what gives stocks value. But let me move on just real quick. So the way that they were doing this was buying on margin. And that means that they were not paying for the entire stocks themselves. They're paying for only a portion of the stocks and giving the rest on loan as a way to increase their leverage in the market. Now, the problem with the margin is at some point you can just get a margin call. It's not like a loan you pay back a little bit at a time. Your broker can ask for all of their money at once. If I want to buy 100,000 shares of a company, but I can only afford 100 shares, I can still buy 100,000 shares with a loan. And if the stock goes up, I sell all those shares, give the other shares and the portion back to the market maker, and cash out my profits. But if that stock goes down, I'm still liable for all of that. And so what happens is any little dip in the market will trigger a margin call, which triggers mass selling. All right, so let's talk about what makes a stock have value. Stocks are valued just like anything on the market with supply and demand. The value of a stock can be connected to the value of a company, but it is often connected to supply and demand as well. So if there's only one stock of Google, Google being a very valuable company, that stock is going to be very expensive. If there's two, now that stock is reduced in half. So a theoretical company that's worth $100 total, and there are two stocks, each share of the company is worth $50. And then you keep doing that. If there's 100 shares, each was worth $1. So you could have two companies with the same general value of $100 each. But if one company has two shares and the other has 100 shares, the share of the company itself is going to be cheaper. Now, that is how stocks are related to the actual value of a company in terms of the assets the company owns and the number of stocks and the success of the business. If I have a business that makes $1 billion in revenue a year and that exceeds my expenses by $500 million, that's a very valuable business. I'm going to be able to find buyers for that. Some businesses' value, though, are only theoretical and what they could be in the market later on. You don't always know which businesses are going to succeed and which are going to fail. If you go back in time to 2010 and you look at Blockbuster, you wouldn't have expected Blockbuster to fail. But they did. You maybe would have been investing in Netflix and seeing that they were not making a profit. But you take a chance anyway. This is the perceived value of your business. This is where demand comes in. Stock prices will rise based on who wants their stock. Even if the business is really good, some stocks are really worth more just because of perceived value. Tesla right now is insanely valued, like way overvalued, because people have demand for Tesla stocks because it could completely change the auto industry. Maybe. But that's what people are doing. They're investing, they're taking risk, and sometimes those risks become outsized and not connected to actual dollars and assets, and instead risk. Now, this is called speculation. And in the 1990s, the internet was new. And the internet speculation got a little bit out of hand. We ended up making a ton of new websites, some of which made it. Amazon.com completely revolutionized the way that we buy and sell and trade. Pets.com did not. And so many people were jumping on this new internet hysteria, and that drove demand way high for stocks. And what you see here is the NASDAQ composite, which is basically a composite of tech stocks from 1986 to 2010. And you'll notice this big spike in the middle. This is when the mania was crazy. If your business name had .com in it, people bought it because the internet was revolutionizing the economy. And you don't have to win every bet. You only have to win one bet. You can invest in 100 tech companies, but as long as you bet on Amazon, at some point you're going to win more money than you lost. But it's entirely speculative of which businesses are going to make it and which ones aren't. And then you get this. This right here is what a bubble looks like. If you have too much speculation, the value of your stock will detach from actual assets and business plans and will be solely driven on demand. And when it's solely driven on demand, that means the value of the stock is only valuable in terms of what someone else is willing to pay later down the line. During this time, there was also Beanie Baby craze, and people were buying sacks full of beans. And they were worthless. And they're still worthless. But they were collectible, and demand was going crazy. And so you thought you could just buy it from someone, turn around and sell at a higher price. And you can do this for quite a while, and people do make money off this. Then you buy it, and then you sell it, and you buy and sell. But eventually, someone buys it, and there's no one left to sell it to. The demand is crazy high. No one wants this thing anymore for this kind of price. And then people are stuck with it. And so they have to sell. And so they sell. But then demand is falling. So other people holding on, seeing that demand is falling, so they sell, and it creates a panic. But then eventually bargain value investors come in, they see the price drop and they're hoping it's going to go up. Like if you look at this chart here, you see the price drops every time once in a while. What a good deal. You can get in for a lower price and then it'll keep going up. And this is what we call the dead cat bounce. And it's called this because if you drop a dead cat from a high enough, it'll bounce. Every stock bounces. And so if you look at this, you see this crazy, it detaches from reality and it booms all the way up to 4,900. That's its price open. If the index altogether is $4,914. And then look, dead cat bounce. If you zoom in here, you'll see that these share prices dip, they crash, it rebounds, and then it crashes again. It's a cycle that is true always. Now, if we look at the NASDAQ, you can see how long it took, and you have the 2008 financial crisis here, how long it takes for the NASDAQ to get back up to its value. It didn't reach the same heights until 2015. The stock market is not a guaranteed success, especially when it's not rational like it was with the NASDAQ in the late 2000s. But if you stayed in long enough, you do see this general trend and you see this general bull market here. So now what are we in? Another crazy explosive time for a lot of factors, a lot of extra income due to COVID and people who got government stimulus checks that didn't need it, put it in the market. But you have a lot of stuff happening with the tech industry as well, streaming and all that kind of stuff, kind of driving prices way higher. And the shift in buying to online, you're seeing Google, Amazon, they are still growing. So what happens after this? I don't know. If I knew that, I wouldn't be making this video. I'd be investing. Now, let's talk about another stock whose value is solely speculative. That would be Bitcoin. Bitcoin's value is derived from its demand and only demand. Bitcoin is nothing. It's a computer program, an algorithm. Same thing as NFTs. And the value of a Bitcoin is only in what you can trade it for in relation to United States dollars. That's how we measure the value. And it's, I'm sorry to any internet people out here or Bitcoin bros, but it's not the future of money. It's not the new gold standard. It's just another currency that is fiat style. It's not fiat. Don't crucify me in the comments, but it is not the dollar. And its value is purely speculative. And if you look at the history of it, you can go back quite far in Bitcoin's history. And if you zoom in enough, you will see what I'm talking about with the dead cat bounces. Here is the bubble of 2018. It got as high as $19,000, and then it dead cat bounced and got as low as 3,000. But there was the same thing here. If you zoom in far enough, you see the same thing. Here's a big old bubble right here. Just keeps going. Boom, bust, boom, bust, boom, bust, boom, bust. This is what Bitcoin does. It is not a stable asset. Anyway, if you zoom out, you can see it did recover. And like, look at that. So what if you just bought here? Even if you just hold on, it would stay go up, but you don't know that. It's speculation. That's what it is. It is just gambling in the market. And demand and hysteria continue to drive it up. And what we see here is in the larger scale is a very large dead cat bounce. Values gone crazy up to 2021. And then since the height, which that was 63,000. At this time, it is 1 year since then, and it has lost 2/3 of its value. So, hate to say I told you so, but I did tell you so. Although if I would have bought it way back then, I would be rich. Maybe I don't know as much as I think. Regardless, Bitcoin's value is only speculation, and it's a risky bet when you're betting on people and trying to be irrational or irrational. They're impossible to predict. Now, back to the stock market crash in 1929. It happens the same way. You're getting a mania of buying in the 1920s. Speculative investing is not attached to reality. And that combined with the risky loaning of money means any dip in the market is going to lead to a crash. And it was basically a house of cards just waiting to be blown over. And that's what happens. And so banks are going to lose a lot of their assets all at once. We'll talk about more of this in the next episode. Are these episodes? I don't know. The next video, whatever. See ya.